And welcome once again to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. And online you can find Jay at retire210.com. It's time to talk about your retirement. We've turned the calendar on a new year, and you're that much closer. Right now, you're thinking about taxes, and you're thinking about financial stuff. So why don't we think about your retirement as well? Jay and I sit down here each week and talk through some of the issues that you might be struggling with. And how are you doing today, Jay?
I'm doing well, Randy. It's been a bit cold. It's starting to warm up a bit now. How's it been for you?
It's been back and forth. I mean, I know that you guys got the ice storm. I live up in Atlanta, and we got it as well, but it didn't turn out so bad. That's good. Boy, some of the people up there in the Midwest and the central part of the country got 12, 16 inches worth of snow. So
they got hit hard. Yeah, I'm glad we should be glad for what we got, right? Rather than what we could have got. That's right. Exactly
right. Well, one of the things that we do here on the show is talk through some of the things that I know that you're probably wondering about. And one of the things that I think is interesting about retirement planning is I want to have as much income as I possibly can. I want my spending money, Jay. Yeah. But at the same time, if I've done a really good job saving, there's some downsides to that because it's like you get penalized for doing a good job because the more money you have, the more your Social Security is taxed. The more money you have and more income you have, the more you pay your Medicare premium. So I look at you and I go, Jay, is it your job to keep our income level down? It doesn't make sense. But there's a balancing act there when you sit down with people, isn't there?
Yeah, there is. And really more to the point of this, Randy, than keeping my income down, it's kind of drilling down into what does that actually mean in retirement? What counts as income in retirement? And managing around this. And this is really like a two-sided coin here that we're talking about essentially is income and tax management. That's really what it is, right? And we talk about that a lot because what are you going to have that counts as income in retirement? Well, you've probably got Social Security. That's going to count as income to a certain percentage, and then maybe some of it will be offset with tax credits depending on your age and depending on your income level. Again, getting back to that. Maybe if you're very lucky, you've got a pension. Right? That's going to count as income. But for most people and most listening to us today, that income issue is going to be withdrawals from 401ks, IRAs, things of that nature. And we talk about it all the time in the fact that, you've climbed that retirement mountain, you've gotten there and you've got your $1 million, $2 million, $3 million, whatever it is in your 401k or IRA. And you're like, great, like I've made it. Well, there's also someone looking behind your shoulder there, the IRS, and they're rubbing their hands together saying, now I get to take my piece of this. So that 1, 2, or 3 million is not really 1, 2, or 3 million. And the key is, is it realistic to say, I don't want to pay taxes at all? Probably not. Is it more of the approach of how can I be as wise with these distributions and keep as much of it as possible? And that's what we're talking about here is how do we tax manage these big buckets of investments we have that are likely now taxable. And, Randy, when you look at the scale of this, we're talking in the terms of tens of trillions of dollars that are in these tax deferred accounts, that are in these 401ks, in these IRAs, in these pensions. And if that's not managed properly, the IRS is going to have a field day with taxing this as it comes out, right? And that's what they're hoping for.
So as you take this money, you have to pay close attention to the tax brackets, the 20 and the 22 and the 24, whatever they all are. And because as you get toward a higher tax bracket, that means your Social Security can be taxed, your Medicare premiums can go up. So as I said, a bit of a balancing act there. Do you run into these things where you look at somebody and you say, okay, we can't go above this level, otherwise it's going to trigger this? But is that really a big consideration? I mean, if your taxes on your Social Security go up a little bit, but you're realizing a lot more income and enjoying your retirement, I guess that's the trade-off? Is that what you talk about?
Well, it's trying to get to that level of enjoying all your retirement and avoiding all those things you just mentioned as well. That would be ideal, right? And what I like to tell people is if we can plan far enough ahead, we can probably do a lot of that. Right? We can probably get ahead of a lot of that. And we have a CPA team that we partner with to do this, because this is getting quite complex now, right? And you really
Sure.
need the professionals in there to help you with it. And we try and get ahead of that as soon as possible. And it comes back to what a lot of things in life come back to, and it's how much time do we have to work on this, right? So we have people that'll come in and, you know, in general, if you think back to your parents or your grandparents, people are retiring earlier now, really, right? A lot of people are retiring mid, late 50s, maybe early 60s. And so they might be in retirement for 25, 30 years. And as soon as they retire, we want to start looking at, first of all, is there a tax problem? I don't like to be a pessimist, but when we're doing our planning, before we even get started and we're just kind of going through the process and the procedures and explaining what will happen to how it'll all work with clients. And I say, hey, look, at the end of this, there's going to be a problem. It's just which problem is it going to be, okay? Is it that, okay, retiring at 60 and living the retirement that you want is not really practical with the assets that you have, and we have to look at some options now, right? Do we cut back the retirement lifestyle a little bit, so retire earlier? Do you work longer? We've got that issue we deal with. If everything's really good and we say this is a slam dunk, you know, you should retire when you're ready, doesn't mean you retire now, but when you're ready, likely, if we're going down that path, the next discussion is, by the way, as you can see here with these projections, there's going to be a tax issue if we don't start managing it now, right? So we're going to have one of those two paths to go through. And we say, let's get started as soon as possible. Where people get into trouble the most is when they do no planning on the tax side. And then you get to your required minimum distribution age, right? Your RMD. And that can be, for a lot of people listening, it's going to be 75. For some of you, it's going to be earlier. And then our options are very limited, right? That scope really starts to narrow down. And the best, I've shared this with you before, the best example I've got is we had a couple, so we're in 26 now, 18 months ago, 2 years ago, they came to us. And they had been kind of around for about 10 years. They'd come and see us and then like nothing would happen. And then anyway, on. And before you know, right, 10 years has gone by. And they came in and these guys were in a great financial situation. They work for a big company here. There's a couple. They were older enough to have really strong pension benefits before the company cut the pension out. Good social securities. And they've each got 2 or 3 million in a 401k that they just never touch. And with all these guaranteed streams of income, they're on 120, 130,000 a year, like very comfortable, right? And they just said, well, yes, we haven't really needed it. You know, we're thinking about leaving it for our kids. And just, anyway, like nothing happened. So when they came in, I think that was the end of 24, they come in and it's like, hey, you know, we want to start working with you. We're going to move all the money over here and, you know, get going. I said, okay, great. And I said, after all this time, what was the prompt? Like, you know, why now? Why did you decide to move forward with working with us now? They said, well, you know, we got notified of some RMP thing or something. I was like, do you mean RMD? Yeah, that's it. And, you know, we've got to take a 6-figure distribution from this account or between us, right? And we weren't planning on that. And it's messing up our Medicare premiums. It's messing up our tax. It's a disaster. We're going to do the best we can for them. But unfortunately, the time to act on that was the 10 years prior. But that's what the issue is that when I bang on about time being a huge factor, there's a reason for it.
And when you look at yourself and say, gee, I should have been in here 5 years ago, or I should have been in here 10 years ago and started talking about moving some of that 401k and that IRA money over to a Roth and start doing those conversions that we talk about. Right. That's why. And this is one of those classic examples of if you try to go this on your own and you DIY it, that's fine. There's enough information out there, but this is where people get into trouble. All of a sudden, you know, you've got as much income as you do, and then your Social Security check shows up and it's $500 short. And you go, what happened here? Or you get your bill for Medicare and instead of $200 a month, now it's $400 a month. You go, what happened here? These are the things that unless you it's hard for us to look down the line and see those things happening. It's not hard for Jay because he's seen this happen before and he can cut these things out. And let's have a plan for what could happen down the line when it comes to taxes. Give Jay and the team a call at Secure Financial Management. Here's the number, retire retire210.com. Pretty simple. Retire210.com. Get a date on a calendar, and what we'll do is a no-cost, no-obligation look at your retirement. Are you headed for a problem like this? Can we help you head it off? Let's talk through it. It's 210-985-6200. 210-985-6200 or retire210.com. Well, we've got another one of these situations, Jay, where politics is starting to get involved with the retirement planning again. And this actually is something that you could do right now, but President Trump has brought it up again, and that is housing is a really, really important part of our economy. And it's a little bit down right now. Think about it. When you buy a house, you buy carpet, you buy furniture, you buy a lawnmower, you become a huge part of the economy when you buy a house. So this whole thing about people not being able to buy a house right now is a big deal. So President Trump says, why don't you go into your 401k? You can go in there, you can take out, if you're a first-time home buyer, you can go in there and you can take out that down payment. I wonder if that's a good idea. It seems like we're trying to solve one problem, Jay, but we're starting another problem. What would you think if somebody said that?
Yeah, I've only dived into this a little bit, and from what I can tell, and I'm still figuring this out, it is a little bit different from what you can do now, right? So if you're a first-time home buyer, I think you're capped at how much you can take out. And I haven't looked at it in a long time. Yeah, one time it was $10,000. Maybe it's gone up from then. I think what he's talking about here, though, is pretty different from that. Because the way it looks to me is the down payment for the house would be like part of the investment inside the 401k. And so, you've got your funds in your 401k, your growth fund, your value fund, whatever it might be. And it kind of seems that the way this is structured is you can take that down payment out, but that is now, because you can hold real estate in an IRA, right? Like it's a bit more complicated and most people don't want to do it because it's a different sort of animal. It kind of seems like you can take this out and it's that $100,000 down payment, per se, is now an investment within the 401k. And to circle back to your point, is this really just a Band-Aid for a broken situation? It kind of seems like that, right? And it's like, hey, instead of addressing the affordability crisis, let's borrow from our future selves and our retirement so I can have a house now instead of really, and isn't this going to make the affordability crisis worse?
Yeah,
right.
Exactly.
If you unlock all this money, there's plenty of people in their 30s and 40s that have multiple six-figure 401ks and IRAs we see it all the time. And so I can't see how this is going to help the affordability crisis. It seems like it's going to bring a whole plethora of new buyers to the market that were not available to begin with, right? So it's like, that's problem one. That's almost like the macro level sort of problem, right? But then on the more individual level, if it is that situation that now the down payment is like an investment inside the 401k, well, then how does that work, right? Because you're not supposed to take money out of your 401k until you're like 59 and a half. So can you not sell your house if you're 30, or you can't sell your house till you're 59 and a half because you unlock that cash? And then if there's a gain, instead of getting a capital gain on it, which is far more tax favorable, now it's income tax. When I first saw this, I thought you were going to bring it up. I thought, we'll end up talking about this at some point on the show. And maybe there's more to be discovered on this, but I see a number of issues with it.
Well, one of the things that we've heard in the past is don't use your 401k as a piggy bank. And it's not. That's not your emergency fund. That's your retirement fund. And you are borrowing against your future that way.
That's right.
So, I can tell you that, in my own life, I got into some credit card trouble and I took some money out of a 401k and I paid it off. And, here I am. And boy, I think about, if I had that money, that would have grown. And, but I did get out of the credit card problem, but it did definitely limit my options for retirement. So you're listening to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management to talk through some of these questions, some of these concerns, some of these things that you might come up with. It's good to have somebody there who you can bounce these things off with, who's been there before. Give Jay a call. Let's take a look at your retirement and see what comes out. about, and you're going to want to know, where am I on this road to retirement? How close am I? Let's get you those numbers. 210-985-6200 is the number, and you can set up a no-cost, no-obligation meeting with the team at Secure Financial Management to get a look at your retirement. 210-985-6200, or use the website, which is retire210.com. Okay, so there's two financial vehicles that we have discussed at length on this show, and there are definitely pros and cons to each one. Mm-hmm. Number one is something you'll find in your 401k, which is a target date fund, and the other one is an annuity. So starting this year, Vanguard decided to introduce to you a target date fund that has an annuity inside it. So we're going to take two wrongs and we're going to make it right, or we're going to take two things that people don't like and make a great thing. I don't know.
What's going to happen is people are going to invest in this and they're going to think they're in a target fund, and then they find out they're in an annuity. That's right. What's going to happen. They're going to be. It's just going to confuse the heck out of them.
Yeah. So, I mean, explain the concept about a target date fund. And I think one of the things that people want in retirement is income. Mm-hmm, so they're going to say, I'm going to go into my target date fund and it's going to give me income. So what does this look like to you?
Yeah, well, let's start with your first question. The target date funds. Most people have seen these in their 401ks, their option target. Target now is usually where it starts, and then probably, what are we, 2026 now? So it'll be target now, 2030, 35, 40, et cetera, right? Mm-hmm. And basically the concept behind this is you're putting it on autopilot, essentially, and they're saying, hey, the further you're away from retirement, so your target date is, I think it's out to 2060 now.
Wow.
Is one of the ones I saw, yeah.
Okay.
You're not going to retire until 2060. Well, it's a lot more aggressive. And then as time goes by, they'll de-risk, with the concept being you should get less aggressive the closer you are to retirement, right? So the real problem with it is that people don't know what does that actually mean, right? Mm-hmm. If you're at 2060, they don't know the underlying assets and how aggressive they are. And on the flip side, what many people think, and this happened in when we had those Trump tariff flash crash things, in April or whatever it was, or March of 25. Mm-hmm. We have people calling us that still haven't retired yet, and they can't move their 401k over yet because they're still at their employer. Mm-hmm. And they said, hey, I'm in the target now because I thought that was super conservative, and I've just seen my portfolio go down 10% in a handful of days. I said, well, you've got to look at this for yourself. It's in the 401k, but a target now doesn't mean that you don't have any exposure to the market. And I said, well, that's what I thought it meant. I thought I was out of the markets. That's the problem is you don't really know what you're in with those things, right?
Okay.
And moving to the annuity, I don't really know how they're going to have a target fund. It sounds like you're just buying an annuity, right? It just seems like that. And, again, you're going to end up with people going into this, and after a year, this hasn't performed that well, I'm going to move it out. And, sorry, you're in it now, and you can't move out. That's what's going to happen, right? Yeah.
I think people are looking for income in all sorts of different ways. And companies are saying, okay, how can we solve this problem? So they're putting annuities in 401ks. They're putting them in target date funds. They're just trying to give people the option of getting income from someplace. But at the same time, I mean, when they have the conversation with you, there are other places to develop income.
That's what I was going to say. So the reason this is going in there is that 401ks are hemorrhaging assets like crazy. Mm-hmm. Right. So what's happening is, their plan was always to essentially offer the 401k to the company. And then the second part of that was, there's not much money in the 401k side of it, but we're going to capture all these people as clients once they retire, right? That's always the plan. Okay. And what's happened is more and more as people have gotten educated, they've looked at the 401k and said, hey, this wasn't so bad when I was accumulating funds, right? When I was 30 and 40 and 50 and I was working towards my retirement, not so bad. But now that I've retired, I need more than 7 or 8 options. I need several different things going on. So this is an attempt to try and retain more of those assets. There's already a few 401ks out there that have these annuity options in them. Mm-hmm. There's a nationwide one we looked at the other day for a police officer. Anyway, there's a few of them that already have it. Mm-hmm. If somebody is inclined to go that route because they want income, I would encourage them strongly to talk to somebody who can do this in the open market for them. Because
that was going to be my question. What are you getting? When you get that annuity,
right?
What are you getting inside that 401k? And there's so many other things to choose from.
Yeah, I mean, if someone's considering that, make a quick appointment to come into the office, and we can show you the world of options rather than this individual option that is in your 401k or 457 or whatever it is. You'd be surprised at the other, often better options you can get there.
You're listening to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. Online, it is retire210.com. And while you're there, go down to the bottom of the page. There's a place for you to put a little information in there. And what is your concern about retirement? Is it Social Security? Is it income? Is it have I saved enough? Is it you're going to retire early and you're worried about health care? There's so many different things that people are concerned about. That'll kind of give us an indication what you want to talk about. We'll reach out to you and we'll get a date on a calendar. And maybe we'll find that there's good chemistry there, and our team can help you, and we'll go from there. 210-985-6200 is the number. 210-985-6200. And Jay, as people go to your website, we got a minute or so here, that at the bottom of the page, when I talk about that, your book, Wall Street's Game, is there as well. Just give me a little synopsis of what that's all about.
Yeah, I wrote that a few years ago, and you can get a free chapter if you go to the site and you download. There's also a space there if you want to book a 15-minute chat just to talk about your situation, see how we can help if you want to book that. But the book that I wrote, and I always tell people this, it was only for a couple of days, Randy, but it was an Amazon bestseller, very briefly, that I'm proud of. So it wasn't for long, but I can still say it, right? Yeah, really what it was is that after being in the industry for so long, you've been in the same space for decades. It's full of sharks. It's full of scams. It's full of all these terrible things that can happen. And it's a book that I wrote to try and give people a peek behind the curtain of how the industry really works and the things to be aware of and to look for. I think it's very valuable. You can get the free chapter there on the site, or it's for sale on Amazon as well.
All right. Might be a good little piece of homework before you come into the office to talk to Jay and find out where his head is and see if you two are together. Retire210.com is the website. Again, down at the bottom of the page, that's where you'll find that, or just give Jay a call. Let's get a date on a calendar for you. It's 210-985-6200. Again, 210-985-6200. 6200. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.